I'm Oliver Renick. You're watching or listening to episode 4 of Gamma On, our weekly limited series discussion about advanced options concepts with a focus on the second derivative. Perhaps no one has done more to popularize this style of market analysis and trading as well than Cem Karsan of Volatility. He's our guest today. He's a veritable godfather of Gamma, the charmer of Vannas. Hello, Cem.
Hey, great to be here. Thanks for having me.
That.
That's quite the intro. I have
Anybody
a lot to live up to.
Done the charmer of Vannas before?
No, I think you're the first.
Beautiful. All right. First to a bad pun still makes it better. Okay, so we have done a few things so far in this discussion, which is kind of set the stage of how people think about Gamma, but we start even more basic, like what is it? We're going to get to that, but first kind of tell me, for those, I think many people who are watching or listening already are familiar with what you do, and they seek out this type of content in no small part due to your popularizing of this content. So how did it get there? Like what brought you to this place where not only is this your area of expertise and what you do in your own trading career, but also from like a outward facing almost educator, if you will?
Yeah, I mean, when I came out to Chicago to work on the floor of the Chicago Board Options Exchange in 1998, there were quarterly expirations only in the index. It was every 1% or so in the index that you could find an option. And the truth is that there was little to no volume if we were trading in eighths, not pennies, right? Different world. But starting at the beginning, when it was that nascent, you really got a sense of how markets work from a mechanical sense.
Okay.
And what's happened since then is markets have become incredibly more diverse. There's a lot of different players than there were. It's much more integrated with the underlying and other markets. The world has become a lot more intricate in the option space in the last 26 years.
Yeah.
But being there early allowed me to see things from a very basic level and really understand kind of the bigger picture. And I think that's what's important. I think they say 10,000 hours makes you an expert. I did a calculation just a couple weeks ago. I think I'm up to 200,000 hours.
Of thinking about this or tweeting about it, posting?
All of the above, right? We have been in the belly of the beast as a trader, as a market maker, running one of the biggest hedge funds in the space, as well as one of the biggest market makers in the space. And so, fortunate to have seen it all, and I've been thinking about kind of this from a bigger picture.
As those new contracts have come into the market, one way I'm kind of thinking about describing it, and I'm curious if this makes sense at all, is did kind of the surface get smoother in a way with like all of these now different, the proliferation of options in terms of just the trading volumes, the amount of people that are taking part, but also every different expiry now, the monthly, the daily, the zeros, right? Does that give you a more pure, kind of smoother picture of the vol surface of the whole market?
Absolutely. I mean, I like to think of these as network effects, right? The market has created a much more efficient, sophisticated product that more people want to get involved in, and by definition, that has made it a better product as well.
Yeah.
Reflexively. That said, the core driving forces are the same they were when I started.
Sure.
And recognizing what they were then at a very basic level is really what helps you take advantage of them more than ever now. That they're more powerful and more meaningful than ever.
I'm joined again by Shane Skinner, manager on the institutional trading team at Charles Schwab, my man who's been with me since we kicked off this show. Shane, great to have you here. Someone who also helped put Cem on my radar early as kind of thinking about these things when we first started doing our discussions. I guess I should also probably plug the show, the fact that you're doing basically a monthly hit with us on Market On Close. Tell me about your process. Like when people come on, they see those hits that you do, whether with us or elsewhere, and you're talking about levels at first glance, and there are still, you've got anybody with a lot of followers also has haters too. And people will kind of look and they'll go, hey, what is all this stuff, right? And like we've painstakingly done that throughout the years, kind of highlighting what these things are. But tell me more about your process. Like when they see that on screen and what you're talking about, how do you arrive at those levels, those numbers?
Right, when people thought the world was flat, right? And Galileo, came out and started explaining how how the universe worked, right? The reality is that people wanted to push it aside and say this is ridiculous.
The Galileo of Gamma, not the Godfather. That's what it should be.
There you go. But the reality is people have been looking at markets wrong from time incarnate. They think of people have come to markets from this initial point of, hey, everything is an asset and has a value, a singular value. Why? Because that's simple. That the value of that thing either goes up or it goes down. But the reality is that assets, right, are much more complicated than just one value. They do much more than go up or down. I could give you two assets that are from the same industry, same market cap, and if I didn't label them in stock or bond world or whatever asset world you want, you would say, oh, those are the same asset, when they could be completely different animals. One could be fat left tail, right distributed. One could be fat right tail, left distributed. And one could have declining earnings. One could have accelerating earnings. They could look completely different from one another in reality. What options do is they allow a three-dimensional understanding of the characteristics of any asset, not just a stock or a bond or a commodity, any asset. It's literally a mathematical expression of the probabilities of the different outcomes, both in time and distance, right, for any asset. So
that layer of convexity gives you more information.
Absolutely.
Right? That's essentially what it is.
And that's always been the case, right? Like I talk about 26 years ago, right? That's been the case since the beginning of time. And there have always been other vehicles to express different forms of dimensionality to an asset. Options, which were listed in 71, 72, and have grown in popularity since, are just the publicly traded version. There have always been over-the-counter insurance. 87 crash popularized the fact that there was a bunch of insurance contracts trading hands that created gamma effects, right? We don't talk about options during that time. There are plenty of examples of it going back to the Great Depression earlier as well.
It's almost as if we were reporting the weather on the ground without knowing there was something going on up there, like what was happening in the clouds, right? We're seeing the same effects, but now, okay, we now understand a little better what's happening up there.
Correct, because they're public and you can see the trading of all these different pieces in an exchange-traded version.
What we do a lot of times in the show is look at that net gamma exposure. And that's kind of visuals that we use a lot. What is your kind of starting point for discovering some of those price levels? To you, what's the most important piece of data that you're pulling? And how do you kind of, stir up that sauce? We don't need to know every ingredient, but kind of how do you get to those levels? What's the most important to you? Like we were talking about yesterday, for example, kind of what's more important when we charted out the net gamma exposure for S&Ps? Was it the flip point where it goes from net to positive, or was it the points down lower strikes that actually had a lot of open interest but weren't really the flip points, that type of stuff?
Yeah, if you want an edge, don't go look in two dimensions.
Okay.
Right? Don't go look for just a ticker that's going to say, oh, beep, right? Like you've hit a level. What we look at in real time is the volatility surfaces in three dimensions of every major asset, and then correlations and relationships between them.
Okay.
Right? Now, when I say correlations between them, you're dealing with what's the correlation between the skew between the different assets? How are the constituents of an index performing relative to the index? All of these things speak to not only pricing, but importantly, positioning as well. So you can look at the trades that happen and understand the positioning, but you can also look at the surface and supplement that with data about price. And everybody's known that price is important when they're looking at a two-dimensional graph, right? But price is very important to that three-dimensional real-time that's also propagating through time. And so understanding how things are moving relative to both benchmarks of history that you might expect, how they're moving, relative to a moving average. But again, instead of two dimensions, across the surface. And I know that sounds incredibly complicated to people. It's actually just drawing another vector and then including that in your data set. It just gives you a much richer set of data and understanding of what the full marketplace and the positioning is in the market, not just long, short.
Right.
But across the surface. And I think that's critical. Again, to reemphasize, asset values, a stock price, a bond price, a commodity price are simply just the expected value of the distribution. If you took all of the data from across the surface and you summarize it to one number, that's the asset value.
Sure.
By arbitrage.
Sure.
It has to. And I think that's the critical thing to understand, that there's so much more data, so much more information out there. And understanding all that information allows you to better predict and better understand what's happening to the actual underlying asset. So I think when people are missing...
tool in the belt.
Yeah.
It's a tool in the belt.
100%. And I think that it's more than a tool in the belt. It is the whole picture. You're essentially, everybody's been trying to look through a keyhole and understand what's going on, when you have now the ability to really look at the full picture of what's going on in real time.
To the point that you made, that's not just because of the way people are trading these at massive volume now. You just believe generally that options are the purest form, the purest window into price that basically we have. It sounds like that is sort of a tenet of the philosophy. Or did that just become that way during COVID when people started trading like maniacs in options?
No, it's always been that way.
Okay.
And I said this during COVID. Actually, we may have even talked about it at the time. Everybody's answer post-COVID, when all of this volume was increasing, was like, "Oh, this is just a short-term thing. Everybody's getting their tendies, their YOLO calls. This will be over."
Yeah,
right.
It hasn't ended.
No, it's just continued, and that's what we said. This is not a function of people just having money and wanting to now play and get to convexity.
Sure.
It is a superior way to position, period, more dynamically, more distinctly tied to a piece of information. If you have a piece of information about a stock or a bond or anything, that piece of information is much more unique than just, do I buy this stock or do I sell this stock? I'm guessing there's a time component involved. I'm guessing there's a convexity to that. What part of the distribution it will most benefit from this piece of information? There might be a correlation aspect relative to another asset. And all of that can be expressed with options distinct directly. And when you don't use options and use the underlying, you're exposing yourself to all kinds of risk that you shouldn't be exposing yourself to. And so the reality is, it's a superior technology. It's a superior way to position. And much like other technologies, they take a while to adopt because you need network effects. You need volume. You need more product. You need daily expirations. You need more strikes. You need more access. You need more education like this, right?
I imagine for a lot of people, I think kind of the way, and I thought about learning about this type of second order, is that it's literally the second derivative. It's a lot like when you are focused on just stocks and equity analysis, and then you start learning about options, and you start realizing, okay, there's market implied moves around earnings, and now I kind of know which kind of levels to think about. When you add in the gamma stuff, literally the second derivative, it's the same kind of concept where you are saying, okay, I had a system, and this is now a better version of that, a sharper tool than what I had. Shane, you think also though, so far like in the show, we've talked mostly about the gamma stuff, because I think a lot of people, it's easier to just start from delta and go from there, but obviously there's other second derivatives on this plane we're talking about. Where do you think that it makes sense to go next, Shane, based on what we talked about with gamma in the last 3 episodes?
Yeah, so I think we need to examine all the various variables that will affect delta, and gamma is just one of them. Time and volatility changing can affect that. Let's quickly define these Greeks. Vanna is a second derivative option Greek. It measures the sensitivity of delta of an option to changes in implied volatility. Charm is also a second derivative option Greek, measuring the decay of delta as time passes. Charm values range from -1 for puts to +1 for calls, within the money options trending towards that -1 or +1, and out of the money options towards 0 as expiration approaches. Option traders who implement delta hedging or delta neutral strategies monitor Vanna and Charm as time passes to look for changes in their deltas, even when the underlying stays where it's at. And so I wanted to dive into why you, Jim, think it's even more important to understand and monitor, if possible, the Vanna and Charm levels versus gamma.
I didn't realize, did they take precedence over gamma in your mind, Jim?
For me, they do. They're both important. It's not like one is more important necessarily, but I think there's more signal and more profitable opportunities tied into Vanna and Charm, and I'll kind of explain why. First, before I dive into that, the specific vectors of Vanna and Charm versus Gamma, I just want to make sure that people don't get so lost in the conversation about second-order Greeks and the math behind it that they feel like this is not accessible or this is somehow confusing. I really want to make sure people understand that three-dimensional distribution that we're talking about, right, can be cut in different vectors, right? You can slice that in one way and say, if this moves, this piece moves this way, how will it affect this other thing, right? That's the beauty of math. You can always
That's the smoother surface now. You got all those different points coming out.
Correct. And each one of these is just taking a slice and saying, hey, if the positioning is this way across this asset, and we move in time forward, or we move in underlying one direction or another, or the volatility of the surface declines, what does that do to delta? Or what does it do to vega? Or these other measures on the surface? That's all we're doing there. And it's important to understand that. And at the end of the day, those movements will change the underlying price, right? That because it's the expected value of that distribution. So if you move that distribution, calls go bid, guess what, right? The call delta is going to increase, right?
Do you believe in the thing people say, like the tail wagging the dog, Cem?
I
Because
hate
it's a
that.
derivative?
I hate that. Actually, I've spun that on its head because I think it's more appropriate. People always call the dog what they are
Looking at at the end.
egocentric, whatever that they're used to looking at. And everybody's been used to looking at stocks based on some two-dimensional thing. I would argue the three-dimensional as a fuller, better picture of what's happening is the dog. It's literally a three-dimensional dog. You've been looking at a two-dimensional dog your whole life, and now you're saying this three-dimensional dog is wagging the tail on the two-dimensional dog. No, the three-dimensional dog is the dog. And that's the dog. The two-dimensional expresses it, right, as a function of what's actually happening.
That's that tenet of volatility being the truest kind of view that you're going to get of something.
The positioning across the whole asset, right? And the stock is part of that positioning, right? But it's not the whole positioning. And the more that you get other positioning across the market, the more important that is to the expected value moving. But it's always been important, right? The insurance products, all kinds of different swaps and things that have gone on since time incarnate, really, from the beginning of markets, right? Insurance as a product, by the way, which is an option, right, has been around since Roman times.
Yeah.
I mean, it's literally as old as the asset itself.
That's a great point.
Right? And so positioning along an asset based on different parts of the distribution is not a new concept. It's not a new idea. It's just we're getting a fuller picture of it.
How do you think the alpha moves from one second derivative to the other? Because you said a moment ago that you think you get better trading opportunities and setups from looking at Vanna or what's the other one, Charm?
Yep.
Oh, so have we been talking about Gamma too much now? The alpha's moved?
Well, Gamma's more. Why do you think people are more focused on Gamma? I have two reasons, I think.
Well, I think number one is that delta is just an easier kind of first derivative to start with.
So agreed. So by the way, there's other important things other than Gamma, Vanna, Charm. Those are all focused on delta, right? But to your point, Gamma is the change in delta. Right. And it's easier for people to go from two dimensions.
Right, just one at a time.
To say, okay, we're just taking the derivative of delta. Now we're talking about the curvature of that delta, right? Yep. So that's why people focus on it. It's a little bit simpler, easier. They're still focused on two dimensions, but this one affects that kind of in a more linear, like in a more direct way.
Yeah.
The other reason is it's convex. So Gamma's exciting, right? Gamma's important when you have a crash, a big event, right? It matters on the tail more. Wherever that big positioning is, it accelerates movement, right? Or dampens it, right? But it really affects the convexity of a move. And I think that creates some excitement and attention to it, right? But remember, and this is why I'll argue the Vanna and Charm are probably more important, even though, again, both very important. Remember, how often do markets crash?
Not often.
Not often, right? I think there's a good market.
Knock on wood.
Yeah.
What is it? November 14th?
Yeah, not making a call on how frequently in the near future.
S&P 6,059.90 right now.
We did, we are about to enter a new, regime in a lot of ways. But a general good market adage is that you go broke trying to bet on market crashes, right?
yeah.
Like you want to bet against the crash
Yeah.
almost every time. Now, gamma matters most on crashes, on acceleration. So 99% of the time, whatever percent you want to call it, gamma is not the most important thing. What happens every day? Time moves forward. Every day. We have an expiration every day. Every day, the world goes on. And every day, implied volatility or expectations for volatility move, right? Many days, we've had years where the market barely moves at all. And yes, gamma supply will matter because it's probably compressing gamma at that point. But the change in delta based on time moving forward seems like a pretty important predictive thing, right? As time moves forward, we're adding this other dimension, this whole other dimension, time, that we haven't been looking at, and understanding the effects of it as time moves.
Which reap rewards for us as well as investors, but maybe in a more patient but reliable, like what, higher probability way?
Exactly. Much higher probability. We know time's moving forward, right? It's not going to go backwards all of a sudden, right?
Yep.
And and again, instead of working maybe 1% of the time or really being valuable a lot and 1% of the time, you have something that's very important every day. And not just every day, by the way. There's a lot of value to this stuff, beginning of the day, end of the day, different periods during the day.
Sure, yeah.
Right? There's a tremendous amount of value to understanding delta's relationship to time. Tied up in that, and why we often talk about Vanna and charm together, is as time moves forward, you actually have a lot of implied volatility effects. Why? Why are those two things so tied? Because there's a curvature to the vol curve, right? So as time moves forward, naturally, things slide down a curve, right? If a vol for today is 10, and a week from now it's 12, right? As it moves forward, the vol of this should go down a path, and the Vanna should also have a tied-in effect with charm. Not just that, right? As these effects move forward and the compression of these factors, they have an interaction with vol. So often as you move forward, if there's supportive positive flows, you'll see vol compression as a function of that. And that vol compression itself, which tends to happen every day in some form or another.
You're talking mostly fixed strike vol. It doesn't only show up if you're looking at VIX, right?
Yeah, exactly.
The
VIX is, again, a two-dimensional summary of a volatility
surface.
surface.
Very clear. That's important.
Absolutely. So, but looking at that, understanding how the vol compression itself, how the gamma and the charm are interacting to create vol compression, will ultimately every day also drive significant flows, right? And so understanding those two are critical, I think, day to day, minute to minute, hour to hour, to understanding how options and the surface, right, is driving effects of that summary, which is the underlying asset.
Shane, I know the name of our season 2, it's going to be Vanna on. But that's pretty much what you look at when you're doing our options hit with this, Shane. I mean, the reason that we are oftentimes thinking about gamma, and we talk about this on the show, is like, for the most part, it doesn't really create these big opportunities. It's mostly we're monitoring it for when the guardrails do break. That's when it gets interesting, to your point. Go ahead, Shane.
Right. No, that's perfect. And I just wanted to sort of follow up that with now that we're on the subject of time and the importance of how, as time passes, it's affecting structure, it's affecting the hedging activity and what's going on with the value of these options and their Greeks. How do you think the cyclical nature and sort of patterns and seasonality we're seeing traditionally in equity trading, how is that pairing up with the sort of, I guess, cyclical or patterns that we typically see in options trading, sort of like monthlies versus the 0 DTE activity versus other forms?
I love that.
So what we're doing right now is peeling back, right, the two-dimensional dog and looking at the three-dimensional and saying, wow, okay, there's a much richer set of factors that are driving these things. And since the beginning, when people are looking at 2 dimensions only, people have seen trends, right? And seasonality, both on a calendar basis as well as during different events or different types of market kind of effects. These adages, for lack of a better word, have some truth to them, right? But generally, we subscribe, magic because we haven't understood. People haven't broadly understood why.
But we got a Trader's Almanac
Benoit
too, though.
Mandelbrot.
Yeah, Trader's
we can
Almanac.
we can check the history.
Yeah,
Exactly. Right. But the
Benoit
history tells you,
Mandelbrot.
right? There's a truth to this, right? Like it's hard to deny that the 2 weeks until from the middle of December till the end of the year, and the 2 weeks from the end of the year to the middle of January, that month is in 120 years of history. It's like an 82% winning rate. That's not magic, right? We subscribe a Santa Claus rally to it, which sounds pretty magical. We've called the other one that January effect because we can't think of another magical.
Being a projecting our ego, like you said earlier, right? We're like, it must have to do with our calendar that we built.
Exactly.
Yeah.
And the reality is there are big structural effects that are coming. What things are tied to that calendar, right? Expirations are tied to that calendar. Certain realities with the end of the year, having to reinvest. These things, the calendar does matter.
Just not Santa Claus.
Yeah, just not because of Santa Claus, exactly. And a big component of why it matters, and this is again why charm is so important, is because of time. Because of time. You have holidays, right? The adage, never short a dull market, right? It's a true adage. You can look at the data. If the market's slow, it goes up. Why? One of the biggest reasons is there is always skew in the marketplace. There is always downs. The biggest carry trade on the planet is downside versus upside in equity markets, right? And at the end of the day, that skew has to decay every day. And if you have holidays or periods where it's slow, that time accelerates. And the Vanna of the decline and the value of that vol paired with the time moving forward creates positive flows in the market. Now, there are other components as well, but that's one that's very important. And it's particularly important at the end of the year because of not just the holidays, but the biggest positioning on all of this happens right at the end of the year because all the structured products and all the hedging tends to happen in the year because that's when reporting is, that's when people, tax season is, et cetera. So those are major, major drivers and big explainers, not the only explainer, of the seasonality that happens during that time. And we can point to other periods that have similar, different effects in terms of seasonality. By the way, we look month to month. If you go options expiration to options expiration, you see other big trends that are also, and maybe even tighter trends that are tied to these options effects. So yeah, seasonality, a lot of these other, the whole elevator down, escalator up piece.
Very true.
I could go through adage after adage. I encourage, we should do a show where you just throw me an adage and I tell you why it's tied to that.
I was just going to mention too, the Benoit Mandelbrot, he is credited with saying essentially that our understanding of markets is like 15th century, 16th century alchemy or chemistry, right? So at that time, you mentioned people call the people who can predict this stuff magic or understand this stuff, they say it's magic. It's not. Just like when someone was doing chemistry in the 16th century, it wasn't magic. It was just that no one understood it yet. And so it's fascinating that as options seem to have expanded and evolved, you're right, they've been here this whole time. They've been futures are another derivative that have been used for things like crops and other things throughout history. It's very much, I loved your comment about it being a pure holistic standpoint and us not truly having that great of an understanding about all this yet.
I'm gonna
We've
go
got a long way to go.
Full Rust Cole from True Detective. It sounds like our insertion of the Gregorian calendar that causes those rebalance flows took an infinite line up and to the right and made it a circle, for us to actually trade on. So we put that man-made dam there, and now everything kicks off from there. Shane, go ahead. I know you got some more thoughts.
Yeah,
Let's talk rates. I like your point about rates. Actually, is a really good one.
I was gonna say let's touch on that. So, zooming out a little bit more, in terms of higher rate environment currently, yes, there's a shift that there's an expected cut coming up, but then who knows after the fact, as well as just shifting central bank policies globally. Um, what do you expect, if anything, in terms of changes in options markets influence on equity price stability, and or how do you expect changes at that level to affect what goes on at the options level, even if it's simply just within the pricing and skew of things?
I love that.
Yeah, great question. Different, prism with which to look at options, right? We were talking supply and demand very much, right, when we started here, which is, how does positioning in the market change day to day? What you're talking about, obviously, is a much bigger structural question, right? And Benjamin Graham, obviously, well quoted as saying, in the short term, a market is a voting machine. That's the supply and demand piece. In the long term, it's a weighing machine. And there is a very important weighing machine effect on volatility and distribution. We've done a decent amount of analysis on this. As it relates to higher interest rates, if we continue to go down this path, which I believe we are, for the next 5, 10, 15 years of increasing secular interest rates, and we don't have to get into kind of the thesis why here, but if we do, what we tend to see is different assets have very different volatility profiles under that regime. For one, industrial commodities, think energy, oil, other copper, tend to actually have lowered volatility.
Okay.
Why is that? Well, because they become much more valuable. There's an underpinning to the downside on these products. Much like we saw other crises in the 1970s, like the OPEC crisis, right? There are entities that are willing to underpin the price of these things because they have some true fundamental value. And the value of those things goes up historically when there's crisis or the value of money.
Pay for limited downside.
Exactly.
Built-in
Physical
structured
assets
products.
up, paper down.
Right.
Yeah. Yep.
So
Less when oil goes negative, of course.
So you still get short-term volatility, to be clear. But if you go back and look at these products, they tend to be mean reverting during that time and maybe have a nice uptrend, right, during these periods. If you look at things like equities, again, short-term volatility, because higher interest rates creates more, you have deglobalization and more global conflict. You may have short-term shocks. But again, if you look at 68 to 82, what's notable? Well, nominally, the market went nowhere. 14 years. I mean, imagine a market that goes nowhere for 14 years. What do you think that does to volatility? That's nominal. Obviously, it declined very slowly as a function of interest rates, inflation kind of eating away at the real value. But at the end of the day, that was very bad for volatility broadly. And importantly, as we went down that path, the volatility declined. Again, not the short-term volatility, but the longer-term volatility declined. Why? Because at some point, when you go from a 25 PE, which is where we were in 68, give or take, to a 5 PE, right? At some point, there's a fundamental value at which, this is just too cheap. We'll own these assets, right? There's very limited downside volatility. And so as we work down this path, if we are actually on the general path that I believe we are for the next 10, 15 years, I would expect for equity volatility, ironically, this is not what people are thinking, to decline as we move forward, because valuations will ultimately come down, multiples will come down, and margins will also compress. So the downside for potential poorer earnings will eventually dissipate.
So then do you think this furthers the argument for someone managing money or handling assets or just trading in general? They really need to be aware of sort of this environment that we might find ourselves in here over the next 10 to 15 years, because it sounds like that's going to be really tough to outbeat the market and or inflation combined. And a lot can be lost over those time periods if you're not careful.
Yeah,
how do you think someone would
different
manage
timelines, right? One of them we're thinking, I would call it investing, right? You should be investing and allocating assets differently, broadly. Another one where, originally we're talking about trading, day to day, week to week, month to month. People confuse the two. They are very different factors that affect, one another. You can at the same time have a view of a 5-10 year outcome that's correct, while in the short term, when I say the short term, I don't mean a week or a day. even multi-year period have a completely opposite view based on things. I'll give you a great example. One of the best things you could have done for the last 40 years is own growth, own emerging market stocks, right? Be focused on equities and being long of equities regularly, buying the dip. That probably wasn't a good idea in 2000. We saw a 92% decline in the NASDAQ over the course of several years, right? That said, if you zoom out, again, you start in 1982, and this is right, 2000 is right in the middle, right? And you go to 2022, it is the best performing 40 years for equities in history, with the best Sharpe ratios, right? And a lot of that, if you just got that piece right and you continue to buy the dip and stay the course and be aggressive on growth and equities, again, we're just talking about the S&P, never mind NASDAQ, tech, all the other things, right? Emerging markets. If you got that part right, the big picture, you're an incredibly wealthy person regardless of all the volatility that happened between here and there. So you have to keep both things in your mind at both times, and you have to understand the big picture while also thinking about the supply and demand in markets and where things currently stand. And I think that's really important.
Coming back to your point about you see vol going down even over the long term, even if we're in an
We're talking
elevated...
10 years again. Let's
for
not
sure,
talk
for sure.
about-
Yeah,
again,
to be clear.
let's hold both ideas in our mind, because I don't want everybody to be like, well, better start selling vol.
We're
for
talking the
next,
big picture here.
yes.
Big picture. The structural question about interest rates. If interest rates stay up, and your view is that vol can come down in that environment anyway, right?
In equities.
In equities, right? Then
And industrial commodities.
Okay.
I didn't get to the rates
Sure,
or
no,
the
even just with
FX
equities.
or the precious metals.
Right.
Different story on that side, and we should get to that as well. But sorry.
just equities, thinking about if interest rates stay structurally higher, because as just a pure mathematical input, like into Black-Scholes, right? Higher interest rates. The idea is call option prices should go up, put option prices should go down generally. Correct me if I'm wrong on that. So is there another force that you're seeing macro-wise that will drive vol down that's not just a pure interest rate calculation going into the options math?
Well, it's not pure interest rate. It is more the effect of higher interest rates on valuations, on multiples, on
Right.
on
So there's
margin.
another level of kind of macro, another wheel,
This is
another
a second
gear.
order
This is
effect,
a
right?
gear that you're saying will turn because of this.
Correct. I mean, if you actually think about inflation on first order effect, right, it should be very positive of performance, right? Like at the end of the day, people usually think of first order effect. First order effect of higher interest rates or higher inflation would mean nominally that assets should go up, right? And they have an uptrend as it is. Why wouldn't they go up more? That's why people get a little bit kind of except the problem with inflation is that means there's an alternative to stocks. The price of bonds goes up, and now there is a reverse TINA effect. We used to call it TINA, right?
Mm-hmm.
Now people's money's flowing the other way. The cost of money going up also just means there's less money chasing every asset, right? Risk premia also go up, which is bad for risk assets. On top of that, at the end of the day, it hurts margins. So yes, GDP may be doing well. Yes, that may be pushing goods prices up. But that's really bad for what's now record margins again, which is what we saw in 68 as well.
Any thoughts on when that second gear might start to turn? Because we've only got about 10 minutes, so let's do this kind of hypothetical then to kind of combine the short into the longer term view. If, as we record this, rates have been dabbling with 4.45 again on the 10-year, if we're going to stay structurally higher, which is what you talked to us about on the hip for a while, and we're kind of drifting that way back again after we had that big, V bottom.
People lost faith, right?
Exactly.
And I
around
said,
the
this
Fed
is your
cut.
opportunity, right? Get back in.
And
this is a secular trend.
And we are starting to see some of that second order effect too, where people are like, oh, rates are going up after the Fed cut. How does that make sense? But if you've been tracking, you know how much sense it makes. So the question about the second gear then is if you think vol goes down in a structurally higher rate environment, but we might be going back up a little bit right now, do we have to express some volatility in the meantime to initiate that second gear, or give me kind of the 6-month look?
Yeah.
I love to pinpoint as much as possible.
No, that's part of what we do, right? The reality is that we are at near record valuations again. Interest rates, there is a catalyst that seems to be appearing, which is a second coming of inflation, which is always what we've argued would be a time for a realization by markets that there's a bigger structural issue. The first time around, people are like, oh, it's just kind of a bout of inflation. We're moving on, right? The second time, people have to start saying, wait a second, there's data in here that tells me this could be a bigger structural issue.
Yeah, we're not going down anymore.
Right. And I've warned about this for some time. That point is a very important point, that second coming. Because when markets lose faith in the ability for the Federal Reserve and for central banks to control inflation, to control the long end of the curve, that's when you can really start to have big structural shifts. And inflation itself can be self-reinforcing, right? The long end of the curve goes higher, break-evens go higher. All of a sudden, people say, "Wait a second, I better start buying stuff. I better start building inventories. I better bring forward demand because I'm going to do better in doing that." That's one. Number two, they say, "Well, I can borrow money at X rate and buy things that are pinned down if I think they're going to continue to inflate." That's probably another reason to pull forward demand. And those will be inflation reinforcing on their own.
Think we're doing that right now? People pulling forward demand at post-election?
I don't think it's happened yet. I think maybe in fits and spurts, but I think that's where we're going. And these things can happen very quickly. It's slow for a while, and then they accelerate. I do think that's the path we're heading down now. Timeline matters.
Yeah.
Putting in, having a presidency, kind of a new president start with new policy can be an impetus to these things. If we do head down this tariff path or tighter immigration policy, meaningfully tighter, these are important inflection points, especially if we start to see these things accelerate and it starts showing that we are having inflation. The world can put pressure on long-term rates pretty quickly. And so that would be my biggest thing to be watching. Timeline makes sense after a big, we're up almost 40% now in 12 months, up to I think 26% or 25% for the year.
You think we're going back above 5% 10-year? For sure?
Absolutely. The question is just when. I would argue that next year we'll see 6%.
Okay. First half or second half? Safer to say second.
I would say second because I think we'll probably get some volatility first half, which might initially
put some bid back in.
Put some bid back in. But again, I think this steepener is the continued trade that the Fed will have to lower rates in the front we'll try to, and that will only exacerbate this steepener.
You think we go back to bull steepener like we were before the cuts, or we stick with the bear steepener since the cuts?
I think bear steepener and then bull steepener.
Okay.
Right. So it's coming, but
it's a little bit more of the same for what we got right now.
For now.
Okay.
For right now.
Cool.
And again, we still have a couple months till next year. So.
Nice.
Cem, you've been saying for quite a while that populism is by default inflationary, and I think we're about to we've already had some great examples. I think we're going to get an opportunity to see quite a few more in the coming months and years as a new administration takes over and we see different things get passed and put into place. So that'll be fun to observe. I want to take an opportunity to ask kind of a fun question here before we sign off real fast. What is your favorite market-related movie, if any?
Oh God,
I like that.
I mean, I'm an old fogey, so I love Trading Places. That's just it's just the crop report. Getting the whole thing. It's a commentary on society as well as markets. Speaks to a different time, and I always love a good laugh too. But there's so many. There's so many in there.
I grew up working on my great uncle's corn and soybean farms. I saw him calling in a trade one day to his futures broker in Chicago. Yep. I asked him what he was doing. He said, go watch Trading Places with your dad. So I went home. I was like 13, sat down and watched it. And ever since seeing that movie, I was like, I want to go.
I think I've seen it. I think I've seen it 30 times. Yeah,
you would
never
think
gets old.
It was based in Chicago, the way Chicagoans love it so much. Like, even though it's in Philly, right? But it's like, right, it's futures and it's commodities.
Exactly.
It kind of brings it home here. What's yours, Shane?
I would say Trading Places as well. Margin call is a good one too. That one's pretty good.
I'm going arbitrage.
Second option to Big Short. Yeah, arbitrage is.
Big Short's great.
I haven't
Arbitrage is a fun one to throw out there in this
while.
conversation, though.
For sure.
Because it's like it's just a Richard Gere playing a scummy hedge fund manager or whatever, a private equity guy. Cem, that was a lot of fun. Glad that we got you.
Always a pleasure, buddy. Thanks
Absolutely. Appreciate the insight both on what matters as far as second derivative functions, what doesn't matter, what matters depending on your timeline. what matters depending on what you're looking for, swings or constancy in markets, and of course the macro stuff too. Great question, Shane. Great help. Thank you, sir. Thank you for joining Gamma On. Thanks for listening. Thanks to Cem Karsan of Tide Volatility and Shane Skinner. I'm Oliver Renick. Thanks for listening. Be sure to subscribe on Schwab Network's YouTube channel, Spotify, wherever you get your podcasts.